Guys, this is Sia Jane and welcome back to the channel. In today's video, we are going to understand an investment appraisal technique in the financial management called the net present value or the NPV method. Whenever a company wants to decide whether it should invest in a project, buy new machinery, or launch a new product, it needs a method to evaluate whether that investment is worthwhile or not. And one of the best and most widely used methods for doing that is NPV. In this video, we will cover what NPV actually is, what NPV actually means, the key assumptions used in discounting, how to calculate NPV, and advantages and disadvantages of NPV. So let's start from the basics. What is NPV? Net present value is a part of a discounted cash flow techniques, also called DCF techniques. Why do we do that? Because of a very important concept in finance called the time value of money. Simply put, money today is worth more than the same amount of money in the future. Why? Because money today can be invested and earn returns. So, when a project generates cash flow in the future, we cannot compare them directly with today's investment. Instead, we convert those future cash flows into present value, and once we do that, we calculate the NPV. The NPV is simply calculated by the present value of cash flows minus the present value of cash outflows. So, how do we interpret NPV? Now, once we calculate in NPV, if it is positive, it means the project generates more value than the cost of the investment. So, the project increases shareholder wealth. Therefore, the project should be accepted. If the NPV is 0, the project earns the required return, which is the cost of capital. So the company breaks even. In this case, accepting or rejecting the project does not change shareholder wealth. No change in shareholder wealth. Yes. Therefore, yes. Now the third case is if the NPV is negative. The project does not earn the required return, so it reduces shareholder wealth. Therefore, the project should be rejected. When choosing between projects, if a company has two mutually exclusive projects, meaning it can only choose one, the company should select the project with a higher NPV because that project adds more value to the business. So, what does NPV actually mean? Let's understand the economic meaning of NPV. Suppose we evaluate a project and we calculate NPV at 12% to be minus $97, NPV at 10 to be 0, 10% to be 0, and NPV at 8% to be plus $108. What does this tell us? If the company borrows money at 12%, the project actually results in a loss of $97. If the project borrows at 10%, the project just breaks even. But if the cost of capital is 8%, the project generates a surplus of $108. So, in simple terms, NPV represents the surplus funds generated by the project after covering the required return. A positive NPV means extra value is created for investors. Now, in exams questions, there are certain standard assumptions we usually follow when calculating NPV. So, let's have a look at them. First, all cash flows occur at the start of the year. Even though in reality cash flow occur throughout the year, for simplicity we treat them as occurring at specific points. Second, the initial investment occurs at time 0, which we call T0. This is the point today when the investment is made. Third, all other cash flows start 1 year later at T1 because the project needs time before it begins generating returns. So let's have an example question. Uh, Suppose a project has the following cash flows at year 0 minus 25,000, at first year 6,000 inflow. These are the inflows. This is a cash outflow. Okay. So and the cost of capital is 6%. So what do we have to do? We have to find a convert these cash flows into their present values, and calculate the net present value of these projects assets, whether it should be undertaken or not. So I'll just tell you the steps quickly and you can solve this on your own. First, we'll discount all okay. So first we'll discount all of these values by 6%. Okay. And multiply each of the cash flow by their discount factor, and add all of these present values together and subtract the initial investment from it. This gives us a NPV. So it's simple. If the NP is positive, accept the project, and if NPV is negative, then we'll reject the project. This question can be solved in the same way. Now let's look at some advantages and disadvantages of this investment appraisal method. First, advantage: NPV considers the time value of money. Future cash flows are properly discounted. Second, it is based on cash flow, not accounting profit. Sorry, this one. Yes. Cash flows are more reliable for decision making. NPV considers the whole life of the project, unlike some methods that ignore later cash flows. Uh, Fourth, it directly focuses on maximizing shareholder wealth, and that is the main objective of financial management. However, NPV is not perfect. There are some drawbacks. First, it can be difficult for managers to understand, especially if they are not familiar with discounting. Second, it requires estimating the cost of capital, which can sometimes be complex. Third, the calculations can be relatively complicated, especially for large projects. But despite these limitations, NPV is still considered superior to many other investment appraisal techniques. Now let's look at the present value tables. In the exam, instead of calculating discount factors manually, you will often be given the present value tables. These tables provide the discount factors for different interest rates and time periods. For example, if the discount rate is 10% and the time period is 5 years, you simply locate the value in the table. This saves a lot of time in the exam. Now, let's quickly have a look at discounting annuities. Sometimes a project generates the same cash flows for every year. Suppose let's look at this example. The same cash flow of $1,000 is being generated for 3 years. Instead of discounting each payment separately, we can use something called an annuity factor. The formula for an annuity factor is very simple. It's just the annual cash flow into annuity factor. And the annuity factor itself is calculated using a formula based on the discount rate and number of years. This makes the calculation much faster. So that's everything you need to know about NPV in ACCA financial management. In this video, I've covered the concept of NPV, how to interpret NPV, assumption used in discounting, how NPV is calculated, advantages and disadvantages, and present value tables and annuities. If you found this video helpful, don't forget to like the video and subscribe to the channel for more ACCA related content. See you guys in the next video. Thank you for watching.